what happens with bonds is you take this example that we were going through, this family that's a 5 out of 10 risk score. And so it goes something like this. The market goes up 20%. They're in their annual review with their financial advisor, and their portfolio is up 10%. And they're looking at their advisor saying, well, what the heck? The market's up 20%. I'm up 10%. What am I paying you for? I could have just put my money in the market and been up 20%. And so the advisor pushes it back to the client, says, whoa, whoa, whoa. You said you were a 5 out of 10. So we built your portfolio so that, yes, you didn't have all the upside, but, oh, we're also not going to experience all the downside. And so they push the blame kind of over to the client. And the client goes, well, okay, I guess it's my fault that I'm only up 10% versus the 20. But the advisor says something along the lines of, okay, but just wait. In a down year, you're going to be really happy with me because you're not going to experience the downside as much. And so next year happens, S&P's down 20% again. Client comes in for the annual review, and the advisor says, look how great this is. You're only down 10%. And client thinks, well, I could have just put my money in a money market account and done 3%. Like, why am I paying this guy? So it's this constant lose-lose situation between the client and the advisor. And it's not that they're always losing money. It's just that the advisor's losing the relationship. We have a number of strategies that we use. We use a 3-bucket approach to the market. So like any other financial advisor, we would say, cool, we want a portion of this portfolio that's focused on growth. And then with the other portion of the portfolio, we're saying, okay, the other 2 things we have to pay attention to in a portfolio one is market risk. We have a bucket that we call our market defense bucket that has 0 market risk. The worst return in any 10-year period over the last 20 years is 10%. The final piece is debt instruments that just spit out cash. Regardless of what the market's doing, it just spits out cash. And again, instead of being in those low single digits, we target 8% in this bucket. And in the last year, it's done 12 to 14%.